Please note that the content shared here is for educational purposes only and should not be considered personalized investment advice or a recommendation to buy or sell any specific securities. The analysis and opinions expressed may contain flaws or overlook critical information, so we encourage you to double check the accuracy of our comments. Both my guests and I may own some of the securities we discuss, but these are shared as examples and may not suit your personal circumstances. So it's essential that you perform your own due diligence before making any investment decisions and always consult a qualified financial advisor before taking action with your portfolio. And with that being said, let's get started. All right. Hi, everybody. Welcome back to another episode of the No More Investing Secrets podcast. It's probably been around 1 month since Andrew and I sat down to record a podcast. We scheduled to record another one 2 weeks ago or so, but then life happened and something interfered. So it's been a while, but we just do it for enjoyment purposes anyway. Although I have to say, and we discussed that before, that sharing the podcast via Substack really increased the number of people we reached tremendously. So it almost 10x'd, at least the last episode we did with Niklas, and obviously he shared it via his social platforms too, but it reached like a much larger number of people in total than our quote-unquote regular episodes do. So let's see if that trend continues. Andrew, I want to start a timer because both of us, we sometimes tend to ramble a little bit, and I'll try to keep the podcast at around 1 hour, and we'll see how that goes. And then I usually like to kick things off by just asking you if there's anything interesting you were reading, watching, studying, listening to over the last couple of weeks. I noted down one name here. I'm not sure if there's anything you want to say regarding him. Steve Eisman. That's one podcast that you recently recommended to me.
Yeah, so the Steve Eisman, I believe it's called the Steve Eisman Playbook, is pretty good. He has it on YouTube and Spotify. I prefer his YouTube. But very interesting, the conversations and the guests he has on. And I really like even though he's very literate in everything that they're saying, the way he runs the podcast is he knows the audience, and he'll always say, okay, slow down, break that down for me, and he'll keep pushing people to further get into the actual details versus just saying kind of one-off comments or something like that. So I really appreciate that. Now a lot of times they're talking about shorting and cyclical and different things like that, more along the styles of investing that you and I probably don't really pay attention to much, but a lot of the insights that you can get just by listening to these conversations, and some of the conversations they have are very, very fascinating. And then also he responded to one of my comments requesting. So for the
I was about to say you had almost a fan moment, right?
Yeah. So I should probably back up and say, for those of you who don't know who Steve Eisman is, he was portrayed in The Big Short by Steve Carell. Now in the movie they changed his name, and in that movie he was stressed out due to his brother committing suicide, it said in the movie. But in actuality, back in this time era, Steve Eisman actually lost a newborn son. And that's why they changed his name in the movie, which is why he's not really as popularly known as Michael Burry. Even though they both essentially did the same trades, the main difference is his name was redacted from that movie. But anyway, so he responded to my comment, which was essentially requesting if he could go into detail about how they knew the financial system was essentially going to collapse back in 2008. And that was essentially us saying, well, I commented saying, we all know the headlines, we all know the general kind of scheme of things, but to really, if he could go into old financial reports and really look at the accounting figures and the footnotes and everything like that, I thought it would just be an absolute masterclass to to my excitement, he responded in one of the podcast episodes saying that he's going to do that. So pretty exciting stuff for those of us who want to learn a bit more about financials and balance sheets and all that sort of thing.
Yeah. Do you have any idea when he'll get around to actually doing that? Maybe
Um,
this year or
Yeah, he keeps saying it's already like in the works and should be coming out soon. So,
okay.
also just a little disclaimer, he is going through some cancer treatments at the moment, so I'm not exactly sure kind of when he'll get around to that. But what I also appreciate is there's no paywalls for anything, nothing like that. Everything's 100% free. He just does this because he enjoys doing it.
Yeah. Yeah, not like my content on the blog. I'm sure he's financially way better off than I am. What
Probably.
came to my mind when you mentioned that actually he lost a newborn, and I didn't know that apparently he's suffering from cancer right now. It reminds me a little bit of Charlie Munger, and like the concept of soldiering through. I'm not sure if you're familiar with.
Yeah,
Um,
yeah. Oh yeah, very very well versed in Charlie Munger's history. Yeah, very resilient. Picking yourself up constantly, moving forward.
yeah,
Definitely. Yeah,
that seems
that's
like what Iceman is doing too. Of course, in the
yeah,
video you sent over, like he seemed so positive, and he really appreciated your message too because you also sent him like greetings and hoped he will be well soon, and he really appreciated that. I could tell from the like little segment he devoted to your response basically.
yeah. And I didn't know this until a little sidebar comment. Well, I know we'll get into the content soon, but I didn't know this until actually rewatching the movie after he responded. I said, okay, I have to go back and rewatch The Big Short. So I purchased it from Amazon and watched it. I didn't realize how much of like a Robin Hood, not the investing platform, but Robin Hood,
Hmm.
uh, the figure, that he really is. Even though he's a wealthy guy on Wall Street and stuff, he hates how non-fiduciary people are. Like it is, he's almost zealous about fighting for the little man and stuff, and he hates like the fraud and the atmosphere of Wall Street and everything like that. So he's very much a man in the system who's against the system, and I very much admire that.
Yeah, yeah, love to hear that. Like what you see on screen right now is a tweet from Theo Bjorkern, which is something I will bring up as something that came or that popped up in one of my feeds and stuck with me. But what Theo actually told me is he apparently like worked in a bunch of corporate jobs too. Like the investing world can be very fierce and unfriendly, and people are very focused on material possessions. So Iceman apparently being from a different cloth. Is that how you say it? I think, right? Cut from a,
Yeah,
he seems to be cut from a different cloth. That seems to be quite rare in that space.
yeah, definitely.
Anyhow, so here's the tweet. And I have some follow-up thoughts. Theo tweeted, Tweety Brown discusses base rates of successful investing, and they outline 5 characteristics. 1, low price in relation to asset value. 2, low price in relation to earnings. 3, a significant pattern of purchase by one or more insiders. 4, and that's the one I actually highlighted, a significant decline in the stock's price. And 5, small market capitalization. I want to focus a little bit on 4 because I feel like in investing, you almost go through that constant motion of learning new things and then unlearning things again. So I actually wrote a blog post about that a while ago, and I might have brought it up on the podcast too. So basically, the analogy of being a vacuum cleaner early on, where you just consume whatever you can get your hands on when you start out, and maybe in your first couple of years, even. But then eventually you realize, well, wait, a lot of the concepts, frameworks I thought were valuable are actually to my detriment when it comes to making good investing decisions. And I'm just going to repeat part 4 again. So, like a contributor to being successful in investing is to buy stocks when they experience their stock price decline. And one lesson I learned, I don't know, maybe 3 or 4 years ago, is that the opposite can be the case too, that you can actually buy stocks at all-time highs even and still do well. So Interactive Brokers comes to my mind here, which is one of these investments that worked out for me. However, I'm not sure if I should unlearn that lesson, because I feel like, and that's sort of my gut feeling, that your overall return expectations will be higher when you truly buy stocks when there's panic and the pricing of the market becomes very inefficient. And that usually comes along with sharp price declines. So I'm not sure if I should focus on that a little more and sort of unlearn the idea of buying at all-time highs too. Yeah, I'm just thinking out loud here. Because just to wrap up my thought, I feel like when you buy a stock after it's down maybe 50, 70%, and obviously that doesn't mean it's cheap because the previous high may have been way too expensive. I feel like we'll probably see something like that in Palantir, for instance. But that seems to be the occasion and the exception, sorry. But usually when a stock is down like 50%, there is some panic and an emotional reaction by market participants. And so you might be able to exploit the behavioral side of market participants. What are your thoughts, Andrew?
Yeah.
Let me break it down for you. Do you prefer buying like after a really bad crash, but usually then there are also things going on, right, leading to it, or yeah.
Yes, I would say based on my tendencies, and kind of my psychology, I'm more prone to getting stuck in a value trap than I am with buying something that had amazing growth where the growth turned around and then I ended up losing money. Meaning I'm much more apt to buy something when the stock price comes down and it turned out to be a value trap versus buying something at an all-time high and then the business fundamentals deteriorate over time. Now,
Yeah.
with that said though, I think the one that you highlighted here, significant decline in the stock's price. I actually think that's almost the most. Yes, the stock price indicates something, but it's rather when buying companies, it's rather irrelevant. So for the viewers, a company that I think we'll be talking about far later in this episode, very interesting, and it's trading near all-time highs right now, and I think it's still like extremely cheap. So I think what's more important is not considering the stock price movement, but considering the valuation agnostic of the stock price based on all the rest of the fundamentals. And realistically, you would suspect typically here's my thought. You want a business that you would suspect should be trading at all-time highs because it's such a good business. However, based on the valuation, you would suspect that it's seen a massive drawdown. And when you can find one of those two where it's not true is really interesting. So, for example, a company that we'll talk about later, based on the fundamentals, you would suspect it should be trading at an all-time high, which it is. However, based on the valuation, you would suspect that it's seen a massive drawdown, which it has not, which means that the market has just not really attributed the proper value, meaning it could be undiscovered, right? Or that there's a fear about the future that essentially just weighs on the company, or it's a narrative that's kind of lacking. Whereas, on the other hand, when you see a company that has seen a massive drawdown, maybe it's an extremely cheap valuation or something like that, you're essentially just trying to buy it um, when when a stock sees a massive drawdown and the valuation is compelling, the market is telling you something is fundamentally wrong with this business and it's going to persist into the future. Many times the market is right about that. There are the rare occasions, though, where the market is often the narrative has changed, but the fundamentals have not. And that's, when you want to buy it. So I think we kind of have to be agnostic of the stock price itself, although it's virtually impossible to do. I get it.
Yeah.
But really, I think just fundamentals relative to the valuation is probably the most important thing. And sometimes the market is just late to understand the real value of a business. And other times they are directionally correct at um, judging that a business's future prospects are not good as their past prospects.
Yep. Yep.
Makes sense.
That's why some of the research terminals also have the what some refer to as business owner mode, right? Where if you activate it, you don't see the historical share price development. So no price chart basically.
Yeah,
What I will
that
say,
would be the best way. That would be the best way to look at companies. And honestly, I sometimes wish I would see that first,
yeah,
instead of
but then
looking.
again, at least for me, like certainly one of the filters for me when I come across the hundreds of stocks I hear about throughout the year, like looking at the stock chart is a bit of a filter, like a snap judgment filter. I just prefer to take a closer look when the stock is down quite a bit from an all-time high, as opposed to one that is trading at an all-time high. So it's hard to really start studying a business without maybe by chance even to have seen the stock chart, right?
I would agree with that. Yeah.
I feel like I'm definitely going through, and we discussed that I think in our podcast conversation with Andrew Brown already. But I'm definitely going through sort of an evolution as an investor, where I feel like we start deviating a little bit in our approach. So let me try to frame it this way. So I think Michael Mauboussin wrote about that there are really three ways to express skill in investing. And as a fundamental investor, the one you are most focused on, or maybe the two, but the one you are most focused on for sure would be security selection. So which stocks to invest in the first place. That's fundamental analysis, and that's sort of what I've learned and practiced for the last 6, 7 years to be like fundamentals only. The other two would be, and the one that obviously plays a role for every value investor too, would be position sizing. The last one would be market timing. I know the term market timing is maybe a bit opaque, but the way I would think about it is just to exploit, as I just said, the behavior of the masses, because I feel like that's another variable at least that can contribute to returns. If you're able to still see the long-term trajectory of a business when it's going through a short-term hiccup, and you might argue that's fundamental analysis too, but sometimes prices just way overshoot on the upside and on the downside, and trying to exploit that like very deliberately is something I'm thinking more about. Let me put it this way. I'm giving this a lot of thought right now, but it's not really influencing my investment decisions a lot right now. But yeah. Anyway, I'm going to move on because otherwise we'll not make it to the stock that you teased already, and we might not get there today anyhow. So the next segment is just market news. I want to show you three tweets and stats basically that I came across regarding Nvidia. Nvidia reported earnings, I think yesterday, maybe 2 days ago. I think the stock actually reacted negatively, but still posted like 56% top line growth. So really remarkable numbers. And actually tweeted about it how goddamn impressive I find the operational performance of Nvidia, because I feel like it keeps beating base rate, so to speak, quarter after quarter after quarter. It's such a big company. That's what this tweet is about. That base rates would suggest a company of that size cannot grow at the rates that Nvidia keeps posting quarter after quarter after quarter. So here you see a chart, and Charlie Bilello wrote about it, that Nvidia now makes up over 8% of the S&P 500, which is the highest weighting for any single stock in the index on record. That's quite remarkable. So here's the chart for you. So you had ticker XOM, phone is in the way, in, well, '08, representing 5%. Microsoft in the dot-com bubble, basically 5%, IBM in the 80s, and now we have Nvidia with a weight of 8%. That's nuts, isn't it?
Yeah. I mean, first off, I don't really have too much valuable insight to add with Nvidia
Yeah, I
for
just
this,
wanted to share it anyway. Yeah.
and it's something fascinating. It's almost an anomaly. But what's crazy is you have the largest companies in the world, most of which saying they're telling you how much capex they're going to be spending. They're telling you what they're going to be spending it on. And at the end of the day, there's virtually one customer. So they're essentially saying over the course of X amount of years, we're going to be paying Nvidia this amount of money. That's that's tough to compete with. I mean that's very very. I don't know of a time in history where that has happened, where all the largest companies have said we're giving all of this money, pretty much most of our profits for the next several years, we're giving to one specific company.
Yeah. Yeah.
It makes
I
sense.
like the way you framed it. Even though they're
Yeah.
working on internal solutions, but at least my understanding is that they're nowhere close to actually be able to replace Nvidia and stop paying Nvidia the billions and billions of dollars they do, right? I'm going to follow up, Andrew, with two more stats here related to it. So I just said highest weighting in the S&P ever. Then here, another tweet. Fun fact, Nvidia is approaching, like the market cap of Nvidia is approaching the size of the entire Nikkei, which is the Japanese stock market. And it is already larger than Canada's entire stock market and the UK's entire stock market. One single
Yeah.
company. That's really nuts.
Yeah, it's insane. I never like those comparisons though. I mean, like yeah, but the just the size of their economies compared to the US and how global we
Yeah,
are.
yeah, I would agree with you that I dislike these comparisons too. So I know Apple posted, or the change in market cap of Apple represents the GDP of country XYZ. But this one is
Yeah.
different because here we're looking at the combined market cap of companies that are listed in a particular country, right? And you actually see an overview. So the market cap of all US listed stocks is 49 trillion, followed by China with, I mean, that gap is pretty massive already with 7.6 trillion. And that's in pounds, I think. Um, Followed by Japan. I'm not sure if pounds correctly, but that's what it displays, right? And then you basically have Nvidia.
Yeah.
Anyway, just wanted to share with you. I know we both don't follow the company closely. We don't have much to add here, but I feel like it's interesting to bring it up
Yeah,
nonetheless.
it's a very interesting time to. It's certainly another experience, just like COVID or anything else like that, that we'll toss in our back pocket for down the line. We'll be able to say, "Oh yes, I've seen this before." As of now, I've never seen this before, so I don't really know how to react. The one thing I will say about Nvidia, just to wrap this up, that does
Yeah.
scare me, I guess, is as you indicated, for example, Google, Microsoft, they are working on internal solutions for this, so that they're not reliant on supply constraints and things like that.
I
What
mean,
if it,
and no longer have to pay these egregious prices, right? So I think Nvidia is posting like 50% profit margins for basically a hardware company. I
yeah,
mean,
exactly.
I know I'm simplifying things here, but yeah,
Yeah, exactly. And I just, my question is, or even when they start getting to scale on these things, and they say, for example, Meta goes from spending 100 billion to okay, we're only going to spend 50 billion this year. What happens to that stock when that revenue suddenly, even not declines, but just that growth goes from 50% down to call it 20%? That that scares me.
yeah,
And I don't know when that will happen. So that's why I just kind of stay away and watch from the sidelines.
yeah. I have two more comments to make here regarding Nvidia, because you just said maybe a few years later we will look back to today and say, oh, that was interesting. I would argue, and that is something I covered in this blog post, in which I covered a bunch of signals that to me are signaling that we are approaching a euphoric stage of the market again. Like one pattern you have seen historically is that you see quite a high concentration in just a few names from an index point of view, close to market peaks. I think Nvidia representing 8% of the entire S&P might be like a small puzzle in that overall picture we are seeing. And there are other indicators too that I'm not going to get into the details here.
Yeah, but
Yeah, yeah.
these are just such dominant. I don't care. I know they probably they sh- they try to shy away from this, but these are such dominant monopolies that are continuing to grow. I just don't in our lifetime, like, and a lot of people compare this to the dot-com bubble, but you had companies with zero revenue, zero earnings, at the top of the stock market. These are the best companies in the world, the most profitable companies in the world, with some of the best, I call them investors, entrepreneurs in the world. I get the comparison. At the same time, I'm also hesitant on my end to say that yes, this is similar to the dot-com boom. That now similar to the dot-com boom. Um, I think what you will see with this. Well, here's another issue with the dot-com boom.
Let me just
Yes.
say one thing here real quick, Andrew, because it fits to what you just said. So
Okay.
you probably don't get around to reading all the blog posts I publish it because I had quite a high frequency over the last 4 to 6 weeks. But I published one post like a couple of days ago in which I outlined a framework for making decisions in investing. And basically, there were 3 pillars to rely on. One is empirical data, which was what I just brought up, that historically you saw quite a high concentration close to market peaks. But then you add 2 other layers. One is theory. I'm not sure which theories you could bring up here, but the one I just noticed in your comment was critical thinking. So I love that. And I actually agree with what you said. I don't think the current environment is comparable by any means to the dot-com bubble. I feel like there's a lot of euphoria in the behavior
Mhm.
of market participants, but the largest companies of the S&P, they can't be compared to the outlook of the largest companies back during the dot-com bubble. Yeah.
Yeah, and what's interesting, like, and don't get me wrong, and I think this, like you say right here in this image, 95% of organizations are getting zero returns. There are definitely pockets of bubbles within the AI, right? To be fair, I think many moats are far less, and the life cycle is going to be far less of these companies than they were 20 years ago, certainly 40 years ago. So I think we're going to see massive booms and busts of just companies of themselves because they'll continue to double revenue for 5 years, and then they could be obsolete by year 7. So I think we'll see a lot more boom and bust of individual companies in different pockets. But unlike the dot-com bubble, where really it was more of a cable bubble, so there was a lot of cable infrastructure being installed in the ground during the dot-com days in anticipation of future demand. What's interesting today, meaning that there was no actual demand, it was just a speculation of future demand. They were trying to build ahead of that. And that's really what fueled the bubble. Whereas today, right, and now you have today just miles and hundreds, thousands of miles of just fiber optics and everything else just laying in the ground being unused. The interesting part about today is the capex being spent to catch up to demand. Like the demand for the need of this AI infrastructure and everything is just so abundant where the Metas, the Googles, the Microsofts, they're all investing to catch up to demand, to try and create the infrastructure to meet the demand. And I think that's kind of a key difference between nowadays and the 2000s. The 2000s was speculating on future demand, whereas today we're investing to catch up to current demand, if that makes sense.
Yeah, it does make sense. And I feel like that would require a very nuanced discussion. But one counter to it, for instance, would be, I mean, there are like hundreds of different use cases for AI, right? In logistics, in healthcare, and so on and so forth. But if we just focus on the most obvious use case, I guess, which I feel like today for the end consumer at least is, or are large language models, right? So ChatGPT just rolled out a ChatGPT 5. There was a bit of a backlash because what OpenAI is effectively trying to do is to use their models more efficiently to bring their cost down a little bit. Because of course there is demand for large language models, but the monetization side of things hasn't been figured out, right? So that would be my counter to it. There's a lot of demand, but the business models are still evolving in a way.
Yes, yeah, and my hunch is that they'll figure out the. I mean, for the past 20 years, I mean, we've been in the old economy and in pretty much all business up until about 20 years ago. It was always, you have to be essentially profitable or from day one to fund yourself. What's bizarre about like the past 20 years with Ubers and Googles and everything else like that was build the infrastructure first, figure the business model out later, which is very peculiar, but that's just currently what we live in. So as much as my investment framework says, yeah, there's no real business here right now, I'm also not, I guess, ignorant to the fact that 10 years
Yeah.
from now,
Yeah.
we'll be looking back and going, oh my God, that was so obvious how they'd make so much money from this.
Yeah. Have you read my piece on Matter that I published after the last quarterly result, where I went into the math of the potential returns they might earn on the capex reinvestments? I'm
I
not sure.
believe I did read that. I'd be lying if I said I remember
Yeah,
everything in it.
I'm just thinking of it because I did the math, and what you have to realize is if you invest money now and don't earn an immediate return on it next year, and maybe not the year after, and the year after, and maybe you only earn money on those reinvestments you make today, 10 years from now, well, then the money you have to earn a satisfactory return, whatever your hurdle rate is, must be like significantly higher, if that makes any sense. So that is something to keep in mind as well.
Yep, that's very true. Yep.
And now I would agree with you. You earlier said that there will be a big discrepancy between winners and losers. So I would imagine that probably, maybe to a similar extent, like during the dot-com bubble, there will be a lot of companies that will not figure out the monetization side of things. And that's, again, we're running a podcast, so you can't see what we see on screen right now, but that's what the piece I have on this slide here states. And this was shared by William. Shout out to William in our WhatsApp community. And basically, it's a paper by the MIT on the current state of AI in business 2025. I'm just going to read like a quick summary to the audience here real quick because I feel like that backs up the claim that I just made. And I don't have a crystal ball, it's just my hunch. So the summary reads, despite 30 to 40 billion in enterprise investment into Gen AI, this report uncovers a surprising result in that 95% of organizations are getting zero return. And I would imagine that zero actually includes like a negative return. The outcomes are so starkly divided across both buyers, enterprises, mid-markets, SMBs, and builders, startups, vendors, consultancies, that we call it the Gen AI divide. Just 5% of integrated AI pilots are extracting millions in value, while the vast majority remain stuck with no measurable profit and loss impact. I'll leave it there. And I feel like we can wrap up this discussion now, Andrew. I feel like that was an interesting piece, or like a food for thought piece to leave our audience with.
Yep.
Okay, let's see. Next segment. Andrew, while I was on holiday on Mallorca, or in Mallorca, I think you say, you reached out to me and asked, because I feel like every once in a while, maybe twice a year or so, you really enjoy writing, putting a thought that you've been wrestling with on paper, right? So you had the idea of publishing a piece that I feel like was on your mind for quite a while now, and then distribute it via my Substack platform, which I'm of course like happy to do because I know everything you put in writing is of very high quality, and we would make this really accessible. So I feel like it's a win-win-win proposition. Give us a bit of a teaser. What have you been thinking about, and for how long?
Yeah, so I'm assuming you're implying the free cash flow plus yield one.
Yeah.
Is that? Yep. So free cash flow, pretty much just the math. So there's in investing, there's a framework of a back of the napkin framework where you can do free cash flow yield plus internal growth would give you your expected long-term returns. And for a while I was grappling with this, saying that, based on my own numbers, the math didn't actually work out that way. It only equaled growth. Like, your long-term returns actually only equals growth. Well, after working with it, grappling with it, and then also comparing it to what would the difference be between dividends and everything, I seem, based on all my research, I've definitely come up with a conclusion, proven the math, and it's interesting. Certainly, I think it'd be a good read, and it helps just the viewers understand buybacks versus dividends. One to have each of them. One to not when does the yield matter more than growth? At what point does growth matter more than yield? All of those things. I just it was a concept that was itching my brain for probably a couple of years now, and I finally decided to really, really dig deep into it. Um, and yeah, I found the answer finally, and so I figured I'd publish something on it. But to get me to write, I always say I'm going to do things, and then for every 100 ideas I have, I might do one. So we'll see. We'll
Yeah.
see if I through this. I think I will, though. I think I will.
I was about to say, now that we are on record, when do you think people
Yeah.
can expect to read it?
Yeah. Well, eh, let's say by Halloween, maybe.
Okay, that sounds fantastic. Yeah, I mean, I have to say I'm looking forward to it myself. I feel like the last time you put or wrote down like a very theoretical piece, I think it was on the impact of multiple expansion and compression, and I shared it on X, and it like went viral and reached like over 100,000 people, I think, and people seem to really enjoy it.
Yeah, and there's actually a lot of overlap with this because we're talking about yield plus growth. And
Yeah,
that the one that you're referring to from maybe last year or 2 years ago was essentially the growth versus multiple expansion that you pay. So they're kind of two sides of the same coin, and the math ends up working out. So a little bit of a spoiler, but once again, if we're talking about compounding and growth, it's that magic 5 to 7 years. Growth matters significantly less, and this was the findings in the original piece I wrote. Growth matters significantly less than the multiple you pay, unless you are going to hold it for at least 5 to 7 years. So if you've only been investing for 4 years, 5 years, and you've essentially have had 100% churn in your or 100% turnover in your portfolio, you cannot tell me that you're a growth investor. You have to be focusing on the multiple you pay, because most of your returns, mathematically speaking, have come from the multiple, not the actual internal rates of return in the business. But
yeah,
that was the finding from the first one, and we'll dig into a different concept in the upcoming post.
yeah, yeah. That's fantastic. What was just going through my mind is I certainly had the highest turnover ever in my portfolio this year. And I would have to check, but uh, many of the companies I was holding for the longest are now gone. Meta, Wix, Google, Nintendo. So if I would take a look at the holding period of the stocks in my portfolio right now, I don't think there will be a company that I've been holding for longer than 2 years, actually. I might. I would have to double check. But I'm just saying this because like I would consider myself a long-term investor. Maybe I'm, as I described earlier, shifting a little bit to being a little more active and exploiting maybe certain market inefficiencies. But like actually holding a stock for 7 years is super rare, I think. If you would
Very different.
take 100 active investors and take a look at, well, call it the top 5 positions in terms of how long they have been in that portfolio, I feel like the average of maybe that top 5 will be much shorter than many might expect.
Yeah. I mean, so let's consider that's a good example though. Like, let's consider Meta, right? I mean, Meta is a growth company, so naturally you could say we're growth investors. But over the course, so when did you buy it? 2022, I'd imagine, during the
I think I
massive.
actually bought it for the first time in 2018.
Okay, yeah, so myself included with that.
But
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 let's
but the
say,
bigger, yeah.
yeah, so let's say for simplicity's sake that you did buy it in 2022, the bulk of the investment. Meta has grown like a weed since then, right? Honestly, probably I'd have to pull the numbers up, but maybe increase their internal business by 50%, maybe even more. That is extreme growth in only a few years. Um, However, I'm assuming, and you don't have to tell me the returns, but I'm assuming it was probably 200 to 300% returns, right? Somewhere in that ballpark.
I can tell you that from the 2022 lows to maybe 3 months ago or so to your book, and that math, Meta compounded at a rate of, I feel like it was something like 150% compounded annually. Like really absurd.
Exactly. So even a phenomenal growth company like Meta, and I continue to hold Meta, and I think Meta is growing phenomenally. Um, Once again, mathematically, though, probably 80% of our returns actually came from that multiple going from, near single digits to about 30 times earnings. So, just from a 10 times earnings to 30 times earnings is right there's a 200% return, and then you add a little bit of growth on top of that and you can get some really out of the park returns there. So, but once again, if you held it 7 years, um, and it was still trading at 30 times earnings, yeah, those earnings would have been juiced up from that multiple re-rating. But at 7 years, that growth is actually mathematically that growth is going to be that compounding over the 7 years. That growth is taken over. So yeah, pretty interesting concept to understand, and it really helps you kind of enter into a position where, yes, if you hold a company forever, the growth matters, but really focus on that multiple, because if you're not going to hold it that long, that multiple is going to matter a lot more.
Yeah, well said. Not much to add here. Okay, next segment, Andrew. I called it buy one, leave one. And the idea ahead here is to present you with two companies, and I'm going to chime in myself. And I'm going to challenge you to pick the one you find more interesting. I think most of the companies on the list are, most of the stocks, I should say, most of the stocks on the list are experiencing a little bit of turmoil more recently. So their stocks are down quite a bit, sometimes quite a lot. And I'm just curious which of the two you would find more interesting if I would put a gun to your head, figuratively speaking, of course, if that makes sense. And there might be
Yeah,
two layers to it. One would be interest and circle of competence, because you might just exclude one idea right off the bat because it's outside of your circle of competence. And then for some of the pairings, I think I have 4 in total, we might actually take a look at some of the numbers that you would find interesting. Make sense?
yep. And we're going based on current market valuations, I would assume, during this.
Yeah, yeah.
Okay.
Okay, so first pairing, Yeti versus Crocs.
That's an easy pick. I would go with Yeti because I was actually looking at both of those, ironically, around the same time. And the funny part to this is that I wouldn't be shocked if Crocs actually ends up delivering far better returns on a move forward basis than Yeti.
Mhm.
Just Yeti, I really struggle to understand if Crocs is here to stay or if it's a fad. My wife and I both own a pair, but I struggle to kind of understand the moat to that. Not saying that Yeti has the best moat, but I understand it from a consumer point of view a bit more. I like to call it blue collar luxury. So yeah,
Yeah, I think
I
we
would.
discussed that during our episode on Yeti, right?
Yep. I would go with Yeti. What about you?
I was just about to bring up some data points here because Crocs is actually just from a multiple point of view, which of course is highly simplified. But so let me say, optically, Crocs is actually significantly cheaper. So it's just trading at 8 times earnings, like forward earnings, I should say, versus Yeti's 14 times forward earnings. Both stocks are down quite a bit over the last 3 years. So that's actually quite a long time frame. Crocs is down 46% and Yeti is down 35%. What I should say is, I feel like you have a really good understanding of the brand of Yeti. I feel like you are a consumer yourself. You've been actively like observing consumer behavior with regard to the Yeti brand and some of the acquired brands as well. So I don't have that. So maybe for me it's a little less one-sided, but I tend to agree with you that I feel quite confident that Yeti will still be around 10 years from now. Crocs is certainly outside my circle of competence in terms of me predicting whether that trend, I mean, Crocs has been around for a very long time, right? But I have no idea if they will still be en vogue 10 years from now. So I would rather pay up for Yeti here for the predictability that I think comes with that brand.
Yep. I will say both are actual probably without serious disruption to their business. I think both are probably extremely good takeover candidates too. So that's also just something to consider. I think private equity firms would probably love to acquire both of those brands.
Yeah, yeah, I would agree. And especially at the prices we are
Yeah, exactly.
looking at right now, especially for Crocs.
Yeah.
I do know, I can't recall his name. There's one, if you follow the 13F filings of the well-known investors, there's one investor who apparently transacts super rarely, and he just
Norbert.
bought Crocs last quarter. Not
Yeah.
was it Novalu?
Hell, it was Norbert Liu with Punch Card. Yep.
Oh, you see, it's even the name. Yeah, it's Punch Card. Yeah, I
Yeah,
think
and
he
he
bought
bought PayPal
Crocs
too.
and another one, right?
PayPal. Yeah.
PayPal.
Yeah.
All right.
Both are very strange buys to me for him. You know, I mean, unfortunately, I own PayPal as well, but uh, yeah, that for Norbert Liu, those are very bizarre purchases for me. But topic for another day.
Yeah, I'm just checking because I was curious the revenue growth for Crocs. So over the last 3 years, the company actually compounded its top line at almost 18%. So there's certainly a mismatch if you just look at the past here, like
Yeah.
really solid top line growth and the multiple the company's trading at right now.
Yep, and returns on capital. I think quantitatively, I think this is a typical. I bet you I've never run a Joel Greenblatt screen, but I bet you this would be on the Magic Formula screen. Crocs, just based on my hunch.
Yeah. Another company that comes to my mind in that discussion would be Birkenstock, because I always feel like maybe I'm completely off here, but I feel like Birkenstock is sort of a comparable company to Crocs. So very much focus on that one vertical, if you want to call it like that. So some kind of footwear, um, trading at a significantly higher multiple, if I'm not mistaken. Personally, I do own a couple of pairs. I think 3 pairs of Birkenstock. So I feel more comfortable about them being around, but that's just my personal taste because I feel like Crocs are just ugly. But I'm sure there are other people who feel the same way about Birkenstock. What's
Oh
your
no, that
perception of the Crocs brand?
they're all ugly. It's the utility to them. I mean, fashion nowadays is swaying more towards ugly and more utility. But that's the tough part about fashion. It comes and it goes and flows. So yeah.
All right. Next one, buy one, leave one. We have Fair Isaac Company and Lululemon.
See, that's tough. Fair Isaac.
Again, I would have to check the drawdown. I think both are down significantly. Before you respond, let me pull them up real quick. So FICO over the last 3 years is down 45%. Let's just do the last year. That might have been off. Sorry. It's down 36% of the last 3 years, and yeah, pretty much the same over the last year alone. And Lululemon, I think, should be down more. Yeah, down 51% over the last 12 months.
Yeah. Assuming I can sell at my own discretion,
Yeah.
meaning I don't hold this for too long, I'm picking Lululemon. I think from this level and kind of quantitatively and just my brief assessment, I wouldn't be willing to bet my life savings on it, but I would not be surprised if Lulu doubles over the next 2 or 3 years.
Yeah. And we could directly tie it to the teaser you shared a second ago, because FICO, even though it's arguably, and I feel like you probably agree, I'm not sure how much you've studied that business, probably not much more than I did, but it's arguably the way better business than Lululemon, but it's trading at 45 times earnings, next 12-month earnings still,
Yeah.
despite the 50% drawdown, which is crazy to think about. So I think it traded like 90 times earnings actually, which makes
I mean,
sense if you look. Yeah.
the valuation is the tough part when you get into businesses that earn virtually infinite returns on capital, though. It goes, how much is too much? um, so
Yeah. Yeah. So one investor I definitely respect. I always butcher his name, so I'm just going to call out his fund's name again, which is Valley Forge Capital. He is certainly one investor who has a super low turnover rate, focused exclusively on super high quality companies. And I think FICO was and still is the biggest, maybe one of the two, three biggest companies in his portfolio. But I was surprised, and I'm not sure. Obviously, there's some hindsight bias here, but holding onto FICO at, I think it was trading at like 90 times free cash flow. I'm not sure if that's not a mistake.
yeah, that's tough. I
I
mean, just
mean,
back.
I mean, I guess his counter to that would be that the company has almost infinite pricing power if you zoom out long enough, which would make the multiple on a backward looking basis much less relevant for such a company. So I guess that would be the counter to that. But
Yeah,
still, it feels really pricey.
it does. I don't know if there's the tax implications as well too. So
Hmm. Yeah,
I'm
fair enough.
sure. I definitely wouldn't, but I also have a tough time holding anything above, call it 35 times earnings. So I'm probably not the best one to talk on that topic.
Yeah, yeah. And I know I'll always put a disclaimer at the very beginning of the episodes, but again, just a disclaimer, we do this just for fun right now. This is not investment advice. And I think we should put a disclaimer here, Andrew, that you did own Lululemon for like a day or two, I think. So
Yeah.
you were very actively looking into the name, or at least you were tracking the stock.
Yeah, yeah, and I have to. So for those who don't know, I'm not a day trader, but one of my rules is what I like to do is start with, some people would say it's concentrated. For me, it's a very small position size of about 5%. And if I wake up saying, if I wake up hoping that the market is green that day, I know I shouldn't own that company. And that's exactly what happened with Lululemon. If I woke up and the market was red, I probably would have said, "Damn." So, yeah, definitely not one I want to hold, because realistically, you want to be able to bet big on a stock where you get more and more excited every day that the market goes down. And I did not feel that way with Lululemon.
Yeah. You might
No,
remember that earlier this year I purchased a German small cap, which I sold 1 or 2 days later for pretty much the same reasons.
yeah, because everything about it told me, like I said, I do think this is going to be, satisfactory returns over a couple of years. I think, based on the actual quantitative numbers of nothing seems too much of a red flag for me for Lululemon, quantitatively speaking.
Yeah.
So I really do think it will deliver solid returns on the move forward once a multiple re-rating happens. But just it's clothing. Clothing's a tough industry for me.
Yeah. Yeah. I would say I would be very tempted to buy Lululemon too, just based on the numbers. But to me, fashion is almost like what airlines were to Buffett. I just have a very hard filter regarding fashion, and like Crocs might be getting to a valuation where I might get tempted, but then again, I don't understand that brand well enough. But once we get to the, call it 7 to 8 times earnings territory based on sustainable, like a sustainable profitability profile, I might get tempted because then the downside is like pretty much very limited. But
Yeah.
usually, like I'm not sure if I ever owned a fashion company. Yeah, I did own Michael Kors, but then you might consider that like sort of light luxury, I guess.
Yeah.
Anyway, next pairing, Andrew. So we've got two software names here, Wix.com, which when I put this slide together today, I almost forgot about it. You also owned in the past, so you're like
Yep.
slightly familiar with the name.
Mhm.
Wix.com versus Adobe. Just to give
Yeah.
some context again, Adobe is down close to 40% over the last year. Wix is down 44%.
Yeah.
Wix is trading, sorry for interrupting you. Wix is trading at 21 times next 12-month earnings. Adobe is trading at 16 times.
Yeah. To see both of those are tough, and that's actually why I got
Yeah.
out of Wix was when the whole AI thing was becoming clear. I struggle with a lot of technology right now. I personally think Adobe is on a permanent decline. But the lovely thing about investing, I can be completely wrong about that, but as long as I don't put money behind it, I'm fine. So I think, but honestly, Wix too. That's a tough one. I guess. Okay, let me just say this. I guess I will say Wix just because the founder is still involved.
Okay.
However, quantitatively, I guess Adobe would be the right one to pick. But quite frankly, I have zero confidence on either of those two on the move forward. I
Yeah.
wouldn't be surprised if they do well. I just don't. I really just wouldn't be comfortable picking either of them.
Yeah. I was just thinking those based on how you're hesitating here, both would certainly be stocks where you would wake up in the morning and go like, that's not the right one for me to
Yeah,
own.
because with my luck, I would buy it, and then the next day, some new AI discovery would come out, making their businesses completely obsolete. I mean, like I said, I think Adobe. There's not much. I can I can talk to Google right now and have it generate me and fix photos and virtually everything that Adobe does. I mean, they
Hmm.
even have creation software now. I mean, other than being just so deeply entrenched in enterprises, I don't know what other moat Adobe has now. But maybe I'm ignorant on that front.
Yeah. I'm just going to make more of a general comment here. Like maybe first of all, regarding the pairing, I would also lean towards Wix. And you can tie it to the general comment I'm going to make. So generally speaking, I think you can certainly make the case that software companies are some of the best business models ever invented. Like you can find some of the best business models in the software space, and especially once we've seen that massive shift towards software as a subscription, as a business model, you just have like these business models tick off so many boxes investors would like to see. Software is really out of favor, but software is right now, which is rare. I can't recall any time that I've been investing that software names were so out of favor. I recently shared a chart on X where I put together maybe 10 software names and their last 12-month stock performance, and they were all down like 40 to 50%. What I will say is, of course, the AI disruption risk is real. You described, for example, in what way the AI disruption risk could materialize for Adobe. But I think there's a lot of money to be made in that space if you take a nuanced look at individual companies and how high that disruption risk is actually for that particular company. And I'm pretty sure that certain software names will still be around 15 years from now, and they will actually be benefiting from AI. Um, For Adobe, I'm not so sure. For Wix, I'm not super sure either, which is why I'm not super excited about jumping back in here. But again, I'm going to bring up the blog again here because I just like put down things in writing and it helps me think things through. So I owned Wix for a long time. I sold it in February or early March, and I revisited it in that post and looked at the last 2 quarters. And of course, I had one segment in the post focused on the AI disruption risk. And just thinking it through, I feel like Wix is more of a more defensible business in the age of AI than Adobe is for various reasons. I could go on for a long time here, but I feel like if you don't just create a landing page for your yoga studio where people just get some basic information, but a more complex one where you add booking systems, SEO capabilities, and so on and so forth, that is something that would require a backend server, a platform that the creator of that website can access. And I'm not sure that is something that OpenAI or an LLM of OpenAI or Google or Perplexity or whatever could copy. And I think that is something where like sort of a niche company that is very much focused on that vertical will excel and provide better value to consumers.
Yeah, I think, and this is just me thinking out loud, if I was to look at the space right now, um, I really think just and I know we keep saying AI, it's until everyone's blue in the face, but I think in the world of AI, I think really, if I were to approach it, I would tackle it in the lens of who has proprietary data, because virtually all the knowledge in the world is knowable now. I mean, I'm oversimplifying, of course, but everything that's on the web is knowable, right? I can start myself. My wife and I could spend the next 3 days learning the basics of AI, and we could start developing an app, right? That's never happened before. It used to be $100,000 to get a developer on.
Yeah.
Like there's
I will say,
the
Andrew, let me just say that real quick here. So, at one point in time, for maybe a week or so, I had the idea of launching some kind of stock research platform myself and just using my YouTube channel as sort of a marketing funnel for that. I did like some quick research on what it would cost to get a coder to get that done, and I very quickly threw that idea out of the window because I realized how damn expensive that would be.
Yes, but to code it yourself now, actually, it wouldn't be all that
Yeah, that's your
expensive.
point. Yeah, yeah, yeah.
Yeah, because I've looked into this too. However, this is also reinforcing my point about proprietary data.
Hmm.
So to get access to the financials and everything, you have to pay OTC, you have to pay NASDAQ, you have to pay, I don't know if it'd be Bloomberg or whoever,
Yeah,
but that is the proprietary data I'm talking about. So Google with YouTube, I mean, Google has all of this proprietary data. Part of my thesis that still remains, for example, with PayPal, and probably a bad example because the payment space is very, very tough. But JP Morgan came out and said people or other firms are going to have to start paying for customer data. That did not affect PayPal at all. Why? Because they have some of they actually I did some maths on this, but they have about, for all financial institutions globally, I think PayPal has the third most individual user data globally, something like that. So they're a data powerhouse. But going back to this, I would rather look at someone that has proprietary data, and I know we're not going to talk about them today, but going back to Simsera, which I told you about, um, versus something that's just a platform, right? For example, Wix, Adobe. I don't know of the proprietary data that either of those two have, and that's what scares me.
yeah. I think well said, and I agree with you. Um, that's where a lot of money will be made.
Yeah.
Not on the consumer-facing interface side, if that makes any sense.
Yes. Yeah.
Actually, like that reminds me of a discussion I had on X regarding Wise, and I'm not sure in what way you still follow Wise, but Wise obviously has the consumer-facing business under the Wise brand, but they are also like owning the infrastructure, which they are offering other brands to white label, very similar to IBKR in a way. And he
Hmm.
was making the point, the person I was discussing with, that he would much rather own the consumer facing brand than the underlying infrastructure. And I feel like that is just a very wrong assessment. Owning the infrastructure, obviously, that's a very general statement to make, but like, especially in payments, owning the infrastructure, that's one of the best business models you could come up with. And that's
Yeah,
certainly true for other realms as well.
yeah. Something interesting too, and we won't have to stew on this too long, but mentioning interactive brokers or something. Another place to look based on this, world of AI is companies that can benefit and become more efficient from AI, where their business model wouldn't be disrupted by AI.
Hmm.
So brokerage firms aren't going to be disrupted from AI. However, they can be extremely beneficial from AI. Whereas that's the issue with software, for example, that really does scare me. Is AI, I think, can actually have a real disruption to the actual business model itself.
Yeah, perfect. And we're looking at the timer. We are at 1 hour, 4 minutes, almost 5 minutes. What I will do is we have one more pairing here, and then I'll wrap it up with a sort of a teaser because we had one more segment planned, which you alluded to earlier, which we might
Yep.
get to in the next episode. So the final pairing, and we'll keep that super short, and I know which one you are going to pick, is Novo Nordisk on the one hand and LVMH on the other hand.
Yeah, I'll go LVMH. I don't care for either of them though. But what about you?
Let me ask a follow-up question here. Would you not get tempted in LVMH at the right price? Because I feel like it's something you could get behind. And you don't
Yeah,
have to understand like one particular brand, because it's pretty much that basket across a bunch of different categories of luxury brands. Even though, of course, the LVMH brand, for instance, carries a much larger weight than some smaller brands under the umbrella.
yeah. I think inherently I just have the same feeling. I might feel like I got a great deal and everything, but I'd feel the same way I felt with Lululemon. I'd actually just be hoping for a quick 30 to 50% pop to get out of it. And
Yeah.
yeah, I just wouldn't be comfortable holding it. It's just not in my wheelhouse.
Yeah. Okay. I can give you like a more like I was about to say like give you a more thoughtful answer, but I don't want you to like I feel like it's talking badly about the answer you just gave. What I'm trying to say is I studied both businesses quite extensively, so I'm quite familiar with both of them, and I actually find that the toughest pairing of all so far. If you would have asked me maybe 8 months ago, I would have easily picked LVMH because I would have said, well, Novo Nordisk is outside my circle of competence. But I've done a lot of work on Novo Nordisk over the last couple of months, and I feel like I have a pretty good grasp on the company, the space it's operating in, um, the competition, and so on and so forth. And basically, what you're looking at here is one company, LVMH, that I think will very likely still be around 30 years from now, but that is more of a slow grower. So historically, it grew top line at around 10%, even though that growth was quite cyclical. I'm not sure if they will achieve a similar growth rate going forward. I would probably feel comfortable assuming like 7 to 8% top line growth, but not super fast growth. Novo Nordisk, on the other hand, the space they are competing on in is super dynamic. Like almost like you can go on a 2 week holiday and like leave your phone at home. When you come back home, there might be new development in that regard. However, there's a lot more growth to be gained in the market they are competing in. So obesity care, that's like an absolutely massive TAM. So if Novo Nordisk succeeds in capturing a decent market share in that regard, I think the stock of Novo Nordisk will crush LVMH. But there's a lot more uncertainty. So that's why I'm not sure here. It's not like an easy either or, but I just gave you an overview of why I think both stocks would have very different theses, if that makes any sense.
Yeah, yeah, no, definitely. Well, let me ask you this. When you tackle an investment, and I know my answer, but let me ask you, do you first consider the upside or do you first consider protecting your downside?
I know in theory you should focus on the downside first, all the time, because like a permanent loss of capital of 30, 40, 50, maybe even more percent, that is so hard to make up for again with gains in another stock that I think you absolutely should focus on the upside first. And you allude to the fact that LVMH probably has a limited downside, while Novo Nordisk has a higher upside, but possibly also a higher downside. So yeah.
So that would be the way even if I was well versed in both of those investments, that would probably be the way I'd look at it. And I mean, as someone who's very well versed in Novo Nordisk might actually say, no, the downside, even at a slightly higher multiple, is limited due to X, Y, and Z. Now, I'm not sure about that.
Yeah.
This is not a place I have any
You
knowledge in
could
whatsoever.
argue that the diabetes care business, even though in a way that business might be cannibalized by obesity care, but in a way, like Rookie framed it to me this way in a private conversation. He said, "Well, maybe you just value Novo Nordisk based on their diabetes care business, and then the obesity care segment, which could be life changing for that company, you'd read that rather as a call option."
Yeah, that makes sense.
Yeah. Well, the only thing I would add regarding that whole upside downside discussion is position sizing matters as well. So if I make a stock a big position, then I'm even more focused on the downside. If I place a 5% bet, then I'm more willing to tolerate downside if the upside is much greater.
Yep, that's probably also true as well. Yep.
Yeah. Okay, I'll wrap it up with a teaser. So um we had one last segment planned, but I told you before we hit the record button that we might not get to it. And I just titled it, and I'm not sure if that is an accurate way to phrase it, so feel free to correct me here. The best food business that you never heard of.
Yeah, it's certainly a good if this was a video, that would be certainly a great title for it. I won't say the brand if we're saving this for a future episode. I won't say the company, but it's a food business that I have heard of, but I never knew. It's a very sleepy industry, over 100 years old. I never knew that it was a publicly traded company, only about a half a billion market cap. Um, and due to the business structure, they earn almost infinite returns on capital, which to put it in perspective, they do well over 100 million, I believe, in revenue, and they spend, I think, last year about 300,000 in capex. So, yep.
What I'm thinking of, Andrew, I'm thinking of doing another deep dive on my blog, and I have two companies in mind to do that on because I have to sense that spark of excitement to get to researching an idea. And like the voice message of you I was listening to this morning actually excited me. So that would be the business you just talked about. The other one is Samsara. Which of the two do you think is going to be? Let's do a pairing here. Samsara or the unknown stock? Which one would you rather spend time on?
This is a Novo Nordisk situation versus
Uh-huh. Uh-huh.
LVMH. Samsara 100% has far more upside than the other one that we're mentioning.
Yeah.
However, I'm competitive dynamic and certainly valuation. I think Samsara is at like 12 times sales or something.
Hmm.
I'd have to really consider. Um,
The other
where
company.
the valuation is far more compelling, but high single digit growth. So but infinite returns on capital virtually. So yeah.
Got it. Got it. I'll give it more thought, and we'll discuss one of the names or both in a future episode. Andrew, thanks very much for your time as always, and we'll chat soon.
All right, talk to you. Bye.